So thank you for viewing this program presented by the Yavapai Group of the Grand Canyon chapter of the Sierra Club. I'm Gary Beverly, chair of the Yavapai Group. We're based in West Yavapai County. Our executive committee includes Stan Bindell, Tom Slayback, Jenny Cobb, and Stephen Cook. If you would like to receive our monthly newsletter, email me at yavapaisierra@gmail.com. The Sierra Club was founded in 1872. It's the oldest and one of the most influential conservation advocacy groups in the nation. We're especially committed to protecting the Upper Verde River, other water resources around the state, ensuring clean air and clean water, being sure that public lands are available and accessible to all. We're extremely committed to social justice and to mitigating climate change. Tonight's program is part of Earth Week in Prescott, which focuses on solutions to climate change. This program is intended to give you a personal strategy to combat climate change by managing your investments without supporting coal and oil, fossil fuels, both highly questionable investments for both you and the planet, and to support your other social and environmental goals. The strategy is called Sustainable Impact Investing, and it's designed to generate a measurable, beneficial, social or environmental impact alongside a financial return by selecting investments that align with the investor's social and or environmental beliefs. In this case, concerns about climate change. Our presenters are Jan Bryan, Laura Eisenuk, and John Farmer. All are registered investment advisors with a long interest in environmentally friendly investing. Today's presentation is being recorded and will soon be available on the Grand Canyon chapter YouTube channel. If you do not want your image captured, please turn off your video using the button in the bottom bar of the Zoom screen. And please remain muted to avoid background noise. Responding to questions is a major part of this presentation. Viewers can submit questions at any time by using the chat button in the bottom bar of your screen. After the presentation, we will first respond to the written questions and then open up to verbal discussion and get to all of your questions. So let's get started with today's presentation. I think John Farmer is the first in line to talk to us. So John, go ahead and share your screen and begin to talk to these fine people.
Well, thank you.
Gary, if you're talking, I can't hear you.
Well, can everybody else hear me?
Yes.
Yeah, so Jenny, that's your issue. Sorry. Go ahead, John.
Can you all see that screen?
Just a second. There you go.
Okay. Well, first off, I want to thank you all so much for coming. There really couldn't be a better time for this presentation. I'm sure you're reading the headlines today about what's happening in Ukraine and Russia, and I'm sure you're reading a lot about what's going on with oil and gas. This presentation, like Gary said, is going to be focused more on sustainable impact investing. But what I want to talk about is just some of the general terminology and the evolution of kind of how this has come to be. Going all the way back to the 1700s, we have in 1800s, we have examples of earlier religious organizations to screen out things that they didn't want to invest in, that didn't believe in fundamental religious beliefs. That evolved really all the way up until the 1960s, when we saw the 60s happen, basically, in protest to the Vietnam War. There was a massive cultural shift that happened that many of you are aware of. At that time, the phrase really got coined, and at the time we called it socially responsible investing. And what that term really meant at the time was, how do we screen out the things we don't want to invest in? You can see in this timeline here, going into the 80s, then apartheid, we got involved in South Africa and screening out some of the things there. And in 1986, we actually began to ban some of the newer investments in South Africa. In 1986, Calvert Investment becomes the first investment firm to sponsor a shareholder resolution to tie to a social issue. Calvert was one of the leading companies and is still around today, involved in, at that time, what we called socially responsible investing. And I don't want to bore you by walking you through the entire timeline, but I do want to move you forward to some pretty key critical areas. When we get to about the mid 2010, somewhere around there, Jen and Laura may disagree with me, a new term kind of came on the scene and got adapted in the investment community. I would really say in the early 2000s. And that term was called impact investing. And this term came about, I'm going to stop sharing my screen here. The term really came about because more and more investors were wondering how they could actually put their money to work to do good. So the concept began to change. The old concept of socially responsible investing, what we called it, is how do we screen out the bad stuff, which was typically, you know, it might be pharmaceutical companies, it might be companies that profit from war, tobacco companies, so on and so forth. And the new focus with impact investing came to be, well, how do I put my money and create what I want and do good for the world? So I'm actually investing. And so then out of that term impact investing, this new term sprang up, which is called ESG, and ESG stands for environmental, social, and governance. And I want to read you a proper definition of it because I won't serve you a proper definition from my memory. ESG, environmental, social, and governance. These are measurements of non-financial performance factors, and they're used to measure a company's sustainability. Environmental factors are going to look at this corporation's conservation in regards to the natural world. Social factors are going to examine how a company treats people, both inside and outside the company, so both its employees and its customers. And governance factors are going to look at how the company is actually run and how it carries itself and orchestrates itself. To be a little more granular, environmental is going to look at things like carbon emissions, air pollution, water pollution. It's going to look at deforestation. It's going to look at green energy initiatives, recycling, sustainability issues, what kind of waste management is going on. All those are going to be under environmental. Under social, they're going to be looking at employee diversity and gender diversity primarily. They're also going to be looking at things like data security. They're going to be looking at how their customers are loyal and satisfied with their products. They're going to look at things like sexual harassment policies, discrimination policies. And they're also going to look at any human rights issues. When we talk about governance, so ESG, environmental, social, and governance, we're looking at the diversity of their board members. Political contributions we can look at as well. Executive pay and pay range from their lowest paid salary to the highest paid salary. Any large scale lawsuits they've been involved with in the past. What kind of leadership is in fact happening at the company. And whether or not there is large amounts of internal corruption. So that's government. So ESG, environmental, social, and governance. So what really happened with the evolution of socially responsible investing is it turned into impact investing, which has then created a subcategory called ESG. And so the old concept was, how do we pick the weeds out of our garden? And the new concept with ESG is, how do we water the flowers in our garden? Not how do we pick the weeds, but how do we reward and place capital into these companies that are actually on the forefront of trying to make a change? And my closing thoughts on this before I pass this off to Jen and Laura is most people, when I first got into this business, would ask me about SRI investing, and I would inform them about it because it was always something I was interested in and passionate of. But I was always have to throw in a disclaimer, which was, Mr. and Mrs. Smith, SRI is great, but you're not really going to get the type of percentage returns that you would with more traditional portfolios. I would always have to say that. And it's been a very, very exciting time to be in the investment world in the last few years, because that has decidedly changed. And now ESG performances for the last several years, and in some instances, even in the years prior, has often outperformed traditional asset class and traditionally built portfolios. So that's a little bit about the history and evolution of ESG and kind of where we're at. And from there, I'm going to hand it off to Jan and Laura.
Okay. My name is Jan Bryan, and Laura is going to be running my slide deck for me while I talk to you or with you. Thank you, John, for that excellent job framing socially responsible investing from decades ago into current times and that timeline. Thank you so much. Excellent job. My name is Jan Bryan, and I've got over 30 years of experience specializing in socially responsible investing, sustainable investing, ESG investing. My background is in geography and biology. And when I first got into financial planning, SRI appealed to me because I believe wasting any resource, whether it be natural, human, or other type of resource, is not productive to the planet. It makes no sense on a financial or moral level to waste resources. And fundamentally, that's what we're talking about here. So you can see some of my background. I've been doing this a long time, so the list is a lot longer, but we won't go into that. So the next slide. What is the case for divestment? I want to thank Bill McKibben and 350.org, as well as all the partners that have worked with 350.org over the years for their important work and the attention it has brought to greenhouse gas issues in fossil-free investments. To date, over 1,500 institutions, such as universities, endowments, foundations, nonprofits, private institutional investors have divested over $40 trillion from fossil fuel investments. This represents 25% of the total $160 trillion in global investable assets. So we've got a ways to go, but at 25%, the wave has started and it's big and it's growing. And currently, large Wall Street firms like Goldman Sachs, BlackRock, UBS, and others now have committed ESG departments. So that's a big step forward. You need to do your research, though, when you're considering hiring a firm, because they can often be embracing ESG on the equity side of their business, but they could be financing oil and gas projects at the same time on the lending side of their organization. So, beware. Individual investors have been slower to adopt SRI ESG factors within their portfolios. So, there's more work to be done. The member organization that Laura and I are part of, and that represents financial professionals specializing in SRI ESG, is US SIF. Every 2 years, they publish a trends report. And the last one was 2020. There's another one this year. And they provide a list of 180 sustainable investment mutual funds and ETF options for the retail investor, for the individual investor. That's in a huge contrast to the handful of socially responsible investments that were available when I started in 1990. So it's, the world has changed tremendously. It's gratifying to see. So if we can go to slide 4, please. This is it, folks. This is why we are here. This is the carbon bubble. Humanity is too invested in carbon and it's killing us. The blue circle represents how much CO2 can be emitted until 2050 and still give a reasonable chance of staying below 2 degrees Celsius of global warming, compared with the red circle representing emissions from all known reserves of coal, oil, and natural gas. The red area represents the concept of stranded assets. They are the fossil fuel supply and generation resources owned by oil and gas companies and investors that lose their value as a result of a transition to a low carbon economy. So that red circle, that's the potential for stranded assets. You know, we must decarbonize on every level, whether it's our investments, our consumption, our lifestyle. I mean, on every level, it's important. So we go to the next slide. Early in the 1990s, socially responsible investing was looked askance upon by the larger conventional investment world. People thought we were nutty, or well, we didn't know what we were doing, and that was a crazy idea, you know, being socially responsible with your investment portfolio. So as an industry, as a profession, we all banded together and said, we must prove that you can do as well in socially responsible investing and measure and monitor. And as longtime environmentalists, we all know that which gets measured gets monitored. So that was the task that our community took upon itself. Like, we've got to, you know, get the data and track and benchmark. So that's what we did, or representatives did. And there was a firm in the early 90s called Kinder, Leidenberg and Dominy, and they started the KLD 400 index, which was an index of 400 socially responsible companies that was designed to track the S&P 500 index of non-socially responsible companies. And you can see the green line is the Dominy 400 index. And since May 1st, 1990, the MSCI and MSCI, Morgan Stanley Capital International, bought KLD. So that's why it's MSCI KLD 400 now. You can see that since 1990, the MSCI KLD 400 index has performed 11.83%, and the S&P 500 by comparison 10.82%. And if we could flip to the next slide, please, Laura. You can also see how the two different indexes perform in different years. So in certain market years, the S&P 500 will be down more than the KLD KLD index 400. So this is represents that. So you can see how it does, you know, in various economic cycles. And if we can go to the next slide, this is just a year-by-year comparison of the performance from 1991 to present. So, which is interesting to look at if you like looking at data. So, and there is no empirical data, none, pointing towards underperformance of ESG investments compared with conventional investments. So I want to make that clear. And excuse me, ESG data, all of this performance we're measuring with companies, you know, their environmental performance, their social performance, their governance performance, it is material. And you'll hear that term material. What that means is it is relevant, it is important. So there's an ample body of literature that makes it clear that ESG criteria is material to financial performance. And much work over the past decade has proven that to be that materiality is important. And how do we measure this? Who's doing this measuring? Well, there are international organizations that are dicing and slicing and monitoring like every different environmental aspect of corporate behavior and social and governance behavior. One of those is the Sustainability Accounting Standards Board, SASB. And they set the standards for financially material sustainability information. And they track 77 different industries globally. Another organization is called the Global Reporting Initiative, the GRI. It's a multi-stakeholder process they use that includes corporations, investors, and other market participants. So this is serious. This monitoring and measuring and collecting quality data is a serious financial pursuit by the sustainable investment community. And a recent review of 1,000 studies published in academic journals from 2015 to early 2020 found that a higher ESG rating for an individual company was associated with higher corporate financial performance. So that's good to note. So if we can go on to slide 6, please. I've included this slide, and Laura will go into a little more detail, just so you can get a taste for what are we including in these investment portfolios, these ESG investment portfolios, and what are we trying to exclude? So this just gives you kind of an idea of the detail and the different issues that are being looked at. And, you know, the first mutual fund, the SRI Mutual Fund, was Pax World Fund that was presented in 1971. And basically it was alcohol, tobacco, and weapons manufacturing. And it was an anti-war mutual fund. And I'm sure a lot of you on the call remember Pax World Fund. So, but we've evolved tremendously since then. So now the issues are very complicated and involved, which is fabulous. And as an investor, you have more latitude to include or exclude within an investment portfolio. So that's been a really, really fun part of this evolutionary process for sustainable investing. And a really good resource that you'll see at the end, we are providing a resource list, is there's a nonprofit called As You Sow. They list all of the shareholder resolutions for every year. And the shareholder resolutions are submitted by shareholders to corporations on environmental issues, social issues, and governance issues. And I highly recommend you go to asyousow.org, click on their 2022 proxy preview, and you have to sign in. They want to know who's obtaining it. And they're a wonderful organization, so you can trust them. They're not going to solicit you. And you can see what's going on behind the scenes with corporations. And Laura's going to go into more detail with that. It's just fascinating, and it's good, and it's powerful. So next slide, please, Laura. Okay, so we've said that ignoring ESG with an investment portfolio can be risky because environmental, social, and governance issues are material. They're important. And some of those risks are listed here. The CO2 regulation and carbon pricing. Well, that goes back to those stranded assets. You know, as more regulation and carbon pricing becomes more available, carbon is not going to be a highly attractive asset to invest in. So, I mean, it's risky, and you can see if a company or a portfolio has high exposure to these stranded assets, oil and gas, they have risk. It's embedded risk. So, and then there's competition to oil and gas from renewable energy sources, which is wonderful. You know, we're finally getting here after decades of trying. So wind, solar, hydrogen, whatever, you know, it's all, you know, coming online. So that's fabulous. Also, fossil fuel prices are volatile. And I'm sure we all know that in this current environment. So in the short term, And I want to back up here and say, sustainable investing, ESG investing is long-term investing. It's not pursuing short-term quarterly profits, which of course we want profits, but I think that's been the most detrimental to our economy and our environment, is just the old Milton Friedman, make as much money as you can as a corporation and don't worry, your only duty is to the stockholder. You have no duty to the stakeholders like the communities and the employees. So we're looking at a newer model that does not embrace that kind of old think of Milton Friedman. I think it's destructive. It's been destructive. So we're looking at longer term investing. In the short term, you may, people say, oh, well, oil's doing well right now, but that's short-term thinking. That's short-term investing. So company reputation and brand, that's a big deal. With social media, companies have to be very careful about their reputations. And we saw that with the Dakota Access Pipeline issue that blew up, and the blowback to the banks that were financing the Dakota Access Pipeline was big, and Wells Fargo lost millions and millions of accounts and dollars from account holders who were just not going to do business with them. So company reputation is very, very important. And legal complaints and actions. That's also another very, very important issue. And also, legal actions can hold up projects like pipelines, which makes them more expensive. So these are just, the main list of all of the risks, embedded risks to investing in fossil fuels. So if we can have the next slide. All righty. Let's see. Now, two big issues that have come down the tubes recently, and on the regulatory side, and I think you need to know about them. For years and years, the sustainable investment community, we tried to work with the Department of Labor so they would allow sustainable investments in retirement plans, so that ERISA, the Employee Retirement Investment Security Act, would recognize that sustainable investments were an important part of retirement portfolio. And when Obama was in office, Tom Perez was head of the Department of Labor, and he really got it. And the pendulum was moving towards, hey, maybe these will be allowed, sustainable investments or ESG investments in retirement portfolios. And then the next administration came in and the pendulum swung back, and they were not friendly towards ESG. And now with a new administration, we have greater attention, and it is considered to be prudent and a fiduciary duty of anyone managing a portfolio for an ERISA type plan, oversight by the Department of Labor, to allow ESG investments. This is huge. This is just huge because of the material risks. It is considered a breach. It could be a breach of fiduciary duty to not allow ESG criteria and voting considerations within a retirement plan. We've worked on this for the last 25 years. So this is very, very big. And the next slide, Laura, please. The SEC corporate climate disclosure proposal, that's happening right now. Very soon, the Securities and Exchange Commission is likely to soon require public companies and investment funds to update their reporting requirements about the risks that they're taking relative to ESG. So this is coming, soon. I don't doubt that this will be implemented. We think it's a good idea that companies do have to report their ESG responsibilities. And in the past, as we all know, corporations just offloaded their environmental responsibilities to the public. That's what the Superfund sites are all about. Well, we're not doing that anymore. Companies have to internalize those costs, and they have to report what they're doing. So, that's a good thing. So Next slide, please. So how do you start, refining your ESG investments or implementing ESG investments? You got to do your research. We're going to provide you with a resource list. We use it. These are people that we've worked with for 30 and 40 years, and we trust them. So the list came from US SIF, which is our member organization. So do your research and beware of firms who are new and or using ESG as a marketing tool or greenwashing. Anybody can buy software with algorithms that does ESG. Anybody can do that, but do they have the history and the depth and the knowledge about what goes in and what goes on and with ESG investing? It's really, really important. But everybody's saying they do ESG, so just be aware to ask them what their documented history is with SRI ESG investing. How long have they been doing it? Next slide, please, Laura. So, and then what is the advisor's firm's commitment to SRI in ESG investing? Are they a member of US SIF? That's our professional organization that helps us promote this type of investing with the SEC and the Department of Labor. So it's very important to support your professional organization. Where do they get their information? What SRI industry conferences do they attend and participate in and present at? What boards do they serve on, current and past? Does the advisor or the firm have any complaints in their SEC file? That you should always check that. And don't be afraid to ask well-prepared questions to better utilize yours and the advisor's time. So the next slide, please, Laura. Here's the resource list. It's a good one. So please feel free to Google any of these, research any of these organizations, and we encourage you to do so. And we'll go to the next slide, Laura. I don't want to bore everyone with this. So I've tried to provide you with some good resources to do your own research. And I think there's one last, there's a lot here. So, and I just want to say thank you, Sierra Club. Thank you all for all the work you do. We're honored to be able to present today. And if you have any questions, let us know. Thank you very much. I'll turn the presentation over to Laura.
All right. Hi, everyone. I need to switch screens now for a moment, but okay, share my screen. Just taking a moment to load. Okay. Here we go. All right. Thanks for your patience. I come from New York City, actually, in a very traditional Wall Street environment, but I share Jan's values of the idea of resources. And I was trained very traditionally in economics, and resource scarcity was always fascinating to me. And as I got more and more into the financial world, I realized we need to be thoughtful of what companies are doing with the resources that are, available in this world. And so that's how I got into the impact investing space. And I'm really thankful to be here today. Okay, sorry. There we go. When I think of Sierra Club, I think of actions. And I love how the Sierra Club gives you tangible things that you can do immediately to make an impact in this world. And if we were together, I'd ask you all to raise your hands if anyone was already invested in some sort of impact way, whether it's environmental, social, governance. And I'd also be curious if you were 100% invested in this way. And I think a key thing to think through here is, if you're not, you're probably working with some sort of financial institution. As Jen mentioned, ask them questions. If you don't know questions to ask, reach out to us. We're happy to talk you through that. But pretty much anywhere you're invested right now has some sort of impact option that you can think through. And there's different ways that you can be involved from having a voice with your investments. And so these are the 5 key tools that I like to talk through and that we do with our investments. And so there's a myriad of ways to be involved. Divestment, we've already talked about, but as owners of these public companies, you have votes that you are allowed to vote on different things that the companies are doing, and that's called proxy voting. So I'd be curious if you currently vote your shares, or if your investment advisor is voting shares, or the investment funds that you are in are voting their shares. Do you know who's voting your shares? And do you know how they're voting your shares? We'll get more into all of that. Outside of just the voting that goes on, you as an owner of a company can write resolutions to the company that all the owners of the company have to vote on. And that's called resolution writing. Sometimes you don't have to go that far and you just have a dialogue with the company and they're still super responsive. There's also public policy advocacy, often letter writing campaigns. I know that us at Sustainable Advisors Alliance, we did 18 different sign-ons in 2021, and we've done 11 so far in 2022. And this ranges from refrigerants' impact on climate change, advanced clean cars and clean fleet rulings, deforestation, and those are just the environmental things that readily came to me. So John already talked a little bit about the ESG side, but I just want to remind you there is a whole swath here. Today, we're just talking about the environment, but there's so many different issues that we covered here. So I mentioned the different tools. Well, what does some of this actually look like? Here's what we did in 2021. This is specifically First Affirmative, who Sustainable Advisor Alliance uses for a lot of our investments. So you can see for proxy voting, we voted on over 1,000 different public companies in their meetings. For dialoguing, yes, we made over 100 contacts with portfolio companies. A great example of that is we brought Iron Mountain, which maybe sounds familiar to some of you. They are a paper processing company that, after our client files, once we're done to get rid of them and shred them, we still need to send them somewhere that's secure. So Iron Mountain takes care of all that for us. We brought them together to the table with ADP, who is a payroll company. ADP didn't have anything going on in their renewable energy program, which at this day and age, kind of sad to hear, but we said, no worries. What do you need to have some sort of program? And they said, well, we need a company that we can talk to and ask how they did it. So we brought Iron Mountain and ADP to the table together, and they were actually have a dialogue amongst themselves. And then public policy, Jan has mentioned some of the stuff that's going on at the SEC. We've commented on a lot of that. One that might be more interesting for you all is helping to preserve protected areas. Bristol Bay up in Alaska was one that we commented on last year. And then divesting from state pension plans. Jan got into a little bit of some of the legal issues that can come up. Well, state pension plans have been sued at times for having these different risks to fossil fuels and just stranded carbon assets. We have done a national pension writing campaign, and I actually have testified. I live in Colorado, so I've testified at the Colorado state pension in front of our local House of Representatives. So there's different ways that your investment firm can be involved, and this is just showcasing some of the bigger things. We're not even getting into the weeds really here. All right, so we talked about divesting a little bit. I want you to also just think about you, like what matters to you, you can divest from it. So begin to think about, what is the thing that maybe you personally really want to divest from? And I mentioned work-based plans. Most of you, I believe, are retired, but again, if your investment company isn't already talking to you about this, they have something in there. And if not, you are the client. You should get what you want. All right, 2022 resolution. So John mentioned the first resolution was filed in 1986. It is astounding to think that in 2022, there are 529 resolutions that have been filed. Wow. And that's up 22% from 2021. So, you can see the overall number through the years is slowly going up. I don't think that's going anywhere. These resolutions are going to just keep coming. And that's really exciting for me in my day to day. You'll see these topics span a whole variety, and again, that kind of environmental social governance realm, but we're especially seeing focus right now on racial justice, political spending, and climate change. So in 2022, there are 145 different resolutions focused on the environment. And so that includes the gray and climate change here, the blue and other environment, the kind of yellowish light green and sustainability. That includes plastic usage, chemical footprints, emissions reductions, carbon asset risk. It's like a whole variety of different, we'll call environmental topics. And what happens with these resolutions is hopefully they go to vote at these annual meetings that you as a proxy holder get to vote on. Sometimes though, companies see these resolutions going to the ballot and they're intrigued by them and they say, hey, this doesn't need to go to a vote. We're really interested in this. Like, what can we do? And so a lot of resolutions are actually withdrawn before they even go to a vote. And that's a good thing. That means the company, wants to address it, and you as the filer of the resolution agree to that. And what we are seeing is more and more withdrawals begin to happen over the years as companies recognize these resolutions have merit. We're also seeing the SEC. Companies can challenge these resolutions and say, hey, this isn't material business. This is them nitpicking and micromanaging our business. They have no business being here. And sometimes the SEC is in support of what the companies say there. And so they will just omit the resolution. We are seeing fewer omissions this year, which is so great. So far, we've only seen 30% omissions versus last year in 2021, 9% for omissions. So, we have a supportive SEC. We're having companies be more supportive of these resolutions. And that's really great, for this environment, as we want to see these companies, have reports and target mandates for agreeing to the Paris Agreement and reducing their emissions and methane emissions. We're seeing these companies really begin to commit to it more and more. So I mentioned the proxy voting, right? You as owner of the shares can vote your proxies, or the company that you're investing through is voting on your behalf. So the green that you see at the top is the average support that industry, the financial industry at large, what they are supporting in these proxy votings. And blue is what we have specifically done. So you'll see for something like these climate proposals, we'll support 100% of any resolution related to climate versus the industry average of 49.9%. So I think it's just really important, again, to know how are things being voted, because these votes matter. So I will say, previously companies haven't really loved these resolutions, and previously investment managers haven't really cared as a result of how they're voting their proxy. Back in 2013, only 22% of shareholder resolutions, general support. Today we're at 33%, so still a long way to go. But what you're seeing on the second half of this is climate-related resolutions are beginning to garner not just support, but we're etching over majority support. And what I will say is these resolutions are not legally binding, but once companies realize shareholders are paying attention and voting, they begin to, just get pinched more and more and understand, all right, dang, we really have to do something here. And we were even seeing boards say, hey, we support these resolutions, you should vote for them. Last year was the highest ever support of 96% for Bunge, which is one of the 4 largest agricultural commodity traders in the world. So for the board of directors to support a climate initiative there was astounding. Last year also saw 39 environmental resolutions with majorities, and that was the highest ever. This year so far, we've already had a 95.4% majority for Jack in the Box to reduce cutting their virgin plastics. The stories just keep going on and on of where these successes are coming from. And again, like change is happening. You're having the Coca-Colas of the world to agree their plastic virgin usage, and things like that, that when I think of companies needing to step up to the plate, this is how we get them to speak and get them to act. I did also just want to show, going into the majority votes, again, it's amazing to see how far we've come with the majority voting, which is why the voting is so, but you'll see like 2021, again, phenomenal year. 2022, we're just getting into the season. It really begins to kick off end of April. So keep your ears out in the news. I bet you're going to hear about different things that are happening more and more, but if you look at 2021, that's really what I'd love you to focus on here, just because 2022 is still coming for us. So those are the main things that I wanted to go over. And now I think we're gonna hit it off for questions.
Hi, well, that is really fascinating. It's heartening to see that change is happening. And so Laura is inviting you to be part of that change by exercising your proxy votes. So let me get to a few questions in the chat here. Actually, we don't have any questions in the chat. There's a comment from Julie. She said, as a retired financial advisor, it's great to see the mainstreaming and outperformance of mutual funds and ETFs. So any other questions that people have? There's none written in the chat. I'll give you a minute to do that.
Gary?
Or go ahead, Jan.
If I can just interject here, I want to say, if you look at the As You Sow 2022 proxy preview, you will see that Sierra Club Foundation has submitted 8 shareholder resolutions on climate change. So we want to thank Sierra Club Foundation for their activism. We partner with Sierra Club and a number of environmental organizations. So they're a big, big, important partner. Congratulations.
So that list of resources went by really fast. Is there a way that we can get that? I guess I could make a copy of it from the video, and then, or if you presenters, if you could send me that slide, then I will send it to everyone that's registered for the seminar so that you'll have that to refer to.
Perfect.
So would you guys send me those reference slides?
Happy to, yep.
Okay, great, thanks. Here's another question from Julie. So when you get a proxy vote mailing, what should one do? Why don't you take that, Laura?
Sure. So generally, every resolution has information on the SEC site. to go over what the topic is about. So if you don't understand the language in the proxy ballot, it's a ballot, you know, the same way that you're voting on your local legislature and bigger elections, it's the same sort of fill in a bubble. But if you need more information, the SEC generally has that for you. And that's where I get you started, because both sides of the person who submitted the resolution as well as the company file a statement, and that helps you understand both positions. As You Sow also is a great resource to kind of help you identify, well, what are these topics going about? We have a 19-page proxy voting guideline that helps us go through everything, which can also be found. We can include that in the list of resources as well. So know that there's perhaps some Googling that you'll have to do, but the S and the proxy preview site through As You Sow does a pretty good job to get you started.
Great. Also, could you three presenters send your contact information? You could put it in the chat so that if anyone's interested in contacting you, they can. So Stan has a question. Do you provide specific recommendation on individual proxy statements? I know CalPERS posts all their proxy votes online.
So we have our proxy guidelines available online. I can always access for my clients the voting record, but we don't publicly give those recommendations. And sometimes that's because we're not voting on it until, you know, a few hours or minutes before. There's a lot, you know, we vote on over 1,000 different companies. So it's also just time consuming to be able to make that public. And I will say, we didn't say any company or fund mentioned here is not a specific recommendation. And I feel like for us as fiduciaries, you know, we don't necessarily impose our values on our clients. Sometimes it's up to the clients to tell us how they want their proxies to be voted. So we can't necessarily give a general recommendation that way anyway.
Okay, great. So everyone, if you look in the chat, you can see the contact information for John, Jan, and Laura. And you can save that chat on your computer. So any additional other questions?
I would just want to add, kind of piggytailing on what Jan and Laura said, that there's been a slow and steady growth of ESG investing over the last, 20 or 30 years. But really in the last few years, things have sped up, and it's just going at breakneck speed right now, how popular it's becoming, and how much action is being taken. So it's really an exciting time to be paying attention to this stuff.
So I had another question comes in. Stephen says, seems I recall something about a Sierra Club sponsored investment fund with something like 56 million invested. Is it one of those 181 investment fund possibilities you mentioned? How does it compare to some of the others? I don't know if that's a question you guys can answer off the cuff, but anyway, speak to Stephen.
We can't give specific recommendations, but I think what you're referring to, Sierra Club years ago, a investment fund that was specifically focused on divesting themselves from fossil fuels, which they have successfully done from the onset. And while we can't specifically recommend one fund over another, I certainly can say that it's a good fund.
Okay,
And
great.
John, you broke up for me. That was Sierra Club, the Green Alpha Fund. Was that what you mentioned?
That was the one I mentioned, yeah.
Mhm. It's been around for many years, and it probably is on that list at US SIF. So yeah, it's well recognized, I would say that. We do not recommend it necessarily. It may not be appropriate for you, but it is a recognized investment option.
Everyone on the call should know that we can't make specific recommendations in a public forum, but we can in a private.
Right. Any other questions? And does someone want to speak their question? If so, I invite you to unmute and speak up. I know sometimes typing questions is awkward for you, so. All right, well, it seems like we've satisfied all the questions. Stephen Cook is unmuting. Do you have something, Steve?
Yeah, there's alternative investments. They're kind of hard to categorize. I personally have invested in tree planting in the third world, which is a really high risk thing to do. So you don't necessarily do it to make money. I'm doing it more just because I feel it's the right thing to do, something I believe in. Do the three of you have any other areas maybe like that are kind of like don't fit into the corporate model that you've been talking about, but still might be possibilities out there to invest in?
I mean, I can speak for myself. My platform is open architecture, so I can access just about anything out there as long as it's been vetted as a proper SEC fund and has a minimum amount under investment, has enough track record, and is in good order, then I can offer it.
Yeah, and we definitely deal with private investments, local investments, maybe not necessarily needing to be as vetted as John mentions, but with the caveat then that you as the individual are willing to take on that high risk.
And some of those investments are community investments, CDFIs, community development institutions. And those have been a popular type of investment for some investors. And so, yeah, we deal with a broader realm of alternatives and different types of investments, but we have to be careful. We're highly regulated, so we're very careful.
So let me ask how bonds and bond funds fit into this ESG strategy.
Well, Gary, bonds are just another piece to the puzzle. As you know, when you own a stock, like Laura mentioned, you're a fractional owner in that corporation. When you own a bond, you're in fact lending money to that corporation. Jan brought up a good point earlier in the presentation, is that there is a lot of greenwashing going on with the increased popularity with ESG investing. And so a lot of advisors and companies are kind of talking out of both sides of their mouth, where they may be divesting of themselves, for example, of fossil fuels on the equity side, but they're behind the scenes funding fossil fuel corporations like big oil on the bond side. So bonds are really just another piece of the overall. There are bonds that are very focused, SRI, ESG investing. And I know Jan wants to chime in on that.
I will say that green bonds have become more and more available and popular. So green bonds is a growing component of the bond sector. And that's, it's not large enough, but that's an important development also.
Great. And Julie wants to know if your slides are available in some form. So if you could, presenters, if you could email those slides to me, then I can distribute them to anyone that wants them. So if you could do that, that would be great. Any other questions or comments?
I have a question. I'm down in Tucson. I used to be up in Prescott, but like from
this is Mary Ann speaking to you. Hi, Mary Ann.
Hi, nice to see some familiar names and faces. But like I had, retirement taken out for T. Rowe Price and for TIAA and Fidelity, and wherever I could, I tried to put it in environmental, but I'm not a real financial person. I'd rather that I could go to somebody or some company I could trust that understands all you say, that, hey, companies will divest on one side, but yet they'll still somehow support. So what would be the best advice for somebody like me who really, I mean, I would rather leave it to somebody who I can trust. And I don't know that, I just don't really feel comfortable at this point with T. Rowe Price or TIAA and Fidelity. And I really just like to be able to be comfortable and trust what, you know, an agency or some source, some resource. So I don't know if you can say anything to that.
And I think that Marianne is voicing a concern and an uncertainty that many, many people feel. So thanks for bringing that up, Marianne. Do you have a response for anyone?
Well, I think if you look,
I think that Jan addressed it well. Go ahead, Jan.
if you look at that slide, that, you know, how do you find assistance? How do you locate a person to help you? Check out that slide. I guess, Gary, can you send Marianne
Yes.
the slide deck, and
Yes.
find an advisor who specializes in this and is committed to it and has a history and, you know, credentials. So, and that can take some work, but
And where is it exactly that I'm going to find it? In the slide that is, or what's the title?
it's
You
the
could put that slide back up for a second if you want. See if Laura could find it.
Sorry, I just,
And Marianne, you can go to US SIF and search for advisors in your area that specialize in sustainable investing. So ussif.org would be a good organization. greenamerica.org, also on the resource list. They list advisors who specialize in sustainable investing. So those are two really good resources. Anything else, Laura?
I just think have a conversation, even if you're with, you know, a TIAA of the world, give them a call and have them talk through what they're doing and why. You know, I think you understanding what you're investing in is just as important as the person that you're talking to understanding it.
And I just think you ask a lot of questions and you keep asking until you're satisfied. And if that takes 3 meetings, 4 meetings, it doesn't matter. You keep asking the questions until you feel comfortable.
And if you aren't being respected with the questions you're asking, then move on to another organization or person. So they should absolutely respect you and your questions. And that doesn't happen, then, you know, go to US SIF or Green America and find somebody who will listen and respect you. You know, I've had people come into me over the years and they say, I've talked to my advisors and they just laugh at me, or they just think I'm wacky because I want to invest in, you know, sustainable investments. And to us, that's, of course you do. You know, what other way is there? So you should definitely be respected on all counts.
and a follow-up question, if I'm long distance, if like, I mean, I liked all 3 of you speakers, but I'm down here, can I, you know, somehow communicate with one of you guys or as an advisor and stuff like that? So.
Yeah, Marianne, that's why I had them put their email addresses in the
Okay.
chat. Did you see that? Are you following?
Yeah,
the
no, I
chat?
did write down all their emails and stuff like
Okay.
that, and the phone number too, because, you know, you're a reliable person, Gary, so you respect all these 3 people, and they were very good in their presentation. And just because I'm a little long distance, I'd rather have somebody who I feel comfortable with.
Yeah, I understand, but here you're in Tucson I'm in Prescott, Laura's in Colorado, and we're all sitting here talking. So it's the miracle of modern technology, and that you can have these conversations remotely, you know, so it'll work. It'll work.
Marianne, yeah, we work with clients all over the country. Like, it just doesn't even matter, you know, where the client is. Yeah. And
Well, it's wonderful to know that, because I truly, for the 3 years we lived up in Prescott, truly respected Gary Beverly. And since he is behind so much of this and getting this set up, I secondarily respect you guys because he's very knowledgeable. And I just want to know somebody I can turn to who has these concerns. And I love it. So thank you.
thank you.
So Marianne, it seems like it's really important that you do some thinking on your own and identify the things you think are important. And that's what you'll have to share with whoever you pick to work with. So when you get the slide deck, there was a list in there of things that would be considered negatives to avoid and positives to work for. And so maybe that'll trigger your examination of the things you feel are important. So I'll be sure and send that slide deck to you, okay? And I think that will help.
And I even took notes during the whole thing as fast as I could. So I do have some of the information down because it was so good. So
Okay,
Thank you.
great. Well, that's a great discussion. Stephen Cook, what do you have to say?
I just want to point out as we're wrapping up here, a big unexpected plus of what I personally have gotten out of this discussion. It seems like with all these resolutions that Laura and Jan especially were talking about, this is a way, in a sense, to talk back to corporate America. And it isn't something I expected to get out of this. And I mean, I've been mostly invested in bonds, and I don't have that opportunity, you know, with that investing in stocks provide, you know, with you know, the resolutions and the proxy voting and all this business. So and the limited investments I've had in those with the brokers I was working with, they didn't do anything like what you people have talked about doing. So it's just a big eye opener for me, and I thank you for filling a gap in my education.
Thank you.
And just to speak to that a little bit, Stephen, you know, it's kind of a carrot and a whip approach that ESG is using. And the carrot is trying to, and the whip is to kind of punish them in the event they happen. But just to give you one little example, like when I introduced this, I talked about ESG and I talked about governance and diversity in the boardroom. One of the things that companies have found with more diverse boards is that there's more representation of broader swaths of society, and therefore those inputs are taken into consideration and going out in that company's marketing efforts, and they're increasing their profits because they're having more diverse boardrooms. So a lot of this stuff is just common sense that really just makes a lot of sense and makes these companies better environmental stewards, but more profitable as well.
Exactly. Yep.
I think Greg had a question, Gary.
I can't see all the hands, but I do now. Greg, please go ahead, unmute yourself, and you can even turn your video on so we could see who's talking, if you are willing to do that. There's Greg. Hi.
Sure. Hi. Yeah, I just wanted to clarify. You're planning to send the deck to, I don't know what's happening now. You're planning to send the deck to everybody who's registered, so we all get it, or do we have to ask explicitly for it?
Well, I've been making a list on who to send it to. I could send it to everyone. It's just, that's easy for me to do.
Well, yeah.
If no one objects, let me just do that. And then you can all have all this information. It's good info, you know, so.
Good, yeah, I appreciate that.
If somebody doesn't want that, then drop a message in the chat.
Right, thank you.
Sure. Any other comments? Go ahead, please.
So Roger is also home to thousands of Madeira walruses. They're always on the look.
So Joanne, we can't, whoever's registered as Joanne, we're not really, the audio is strange. Maybe you could be closer to
I
your
didn't
microphone.
say anything. Okay, can you hear me now?
Yeah,
I guess I was really interested in seeing how ESG funds compare with the other like S&P 500 or those kinds of index funds. That's what I was thinking of, and have had lots of discussions with my husband about the merits of environmental investing versus conventional. And he says, well, you can make money on conventional money investing and then have more money to donate to environmental causes. And I guess I would like to do both. I think that would be very useful to me for arguing that issue. But have anything to say to that?
I do. Thank you, Joanne. We've heard that a lot throughout the years, just invest anywhere and donate the proceeds, but that does not create systemic change that is so important in this carbon economy we're trying to change. So, and the data's in, you can make as much money investing in sustainable investments as conventional. So, I mean, in this shift away from carbon, we need to change systemically. And that model that you've discussed just doesn't do that.
And then your other question, Joanne, is how does ESG compare to the S&P 500? The S&P 500 is a fixed and static index in that it doesn't change much. It's reallocated throughout the year to give current representation. But when you go into the ESG universe, there's hundreds and hundreds of different investment opportunities. So it makes it impossible to do a side-by-side comparison.
But I mean, fundamentally, you can look at the MSCI KLD 400 versus the S&P 500. And
yeah, that's what I was looking at, that chart. Yeah,
exactly. And go from there. Yeah.
Okay, thank you.
Good question. Thank you.
anyone else? Please go ahead. Okay, going once, going twice, last call. Great, let's wind this up. Stephen, I think you gave a great summary of this whole presentation. I really want to thank Jan, Laura, and John for this. There's some great information here. This is far beyond what I was expecting. This is wonderful. Thank you all very much. And thank the other 16, 19 of you for attending. Really appreciate it. And I hope that you can take this information and massage your investments so that you do good and you do well at the same time. Okay, so with that, let's ring off and end this seminar, and everybody should go get dinner and be with your family and think on the message. Thanks again. Good night.
Thank you, Sierra Club.
Have a good night, everyone. Thank you so much.
Yeah, thanks to all of you.
Gary.
Good night.
Good night.